All right, what is up, everyone? Today we're going to go over the yield curve, which, if you didn't know, it is actually accessible through Think or Swim. So you no longer have to go to a separate website or a separate platform, as many people don't really know that you can access this type of economic data through Think or Swim. So we're going to go over specifically the 10-year, 3-month yield curve, which is one of the most important yield curves to pay attention to, right? There's the 10-year, 2-year, and the 10-year, 3-month is also very important. Now, this one is going to be a little bit simpler, okay? I do have a separate yield curve chart layout with the 10-year and 2-year yield curve. And then it's also got the Fed funds rate on there as well. As many people are very focused right now at the time of this recording, it's about the middle of 2024. Many people are very focused on Fed rate cuts, right? Or rate hikes or this pause. And what's going to come next? Is it another pause? Is it another hike? Is it another rate? You can check out that chart layout. This one is going to be a little bit simpler, okay? And it's just going to show you the yield curve on top and the S&P 500 on the bottom. So you can monitor and visualize the S&P 500's historical performance as the yield curve is inverted and as it comes out of inversion and as it's moving up and down, you can see these different intermarket relationships, right? You see here, the yield curve is rising dramatically. And then we have a declining stock market, right? Same thing over here. We see a inclining yield curve right here, rising dramatically, and we see a declining stock market, okay? So, specifically, this chart is going to show you guys the 10-year and 3-month yield curve with the S&P 500 displayed below. The yellow horizontal line represents zero, okay? So remember, below zero, all right, that indicates an inverted yield curve. And an inverted yield curve signals decreased investor appetite for risk, often preceding economic downturns. So one of the main reasons that you'll see an inverted yield curve a lot of times is because the bond market, all right, and bond investors are essentially signaling that they don't want the risk, that they think that there could be a recession in the future, right? As it says here, as I've written down, yield curves invert when short-term bonds pay higher yields than long-term bonds. So in this case, the 3-month treasury is paying more than the 10-year treasury, which is not a typical historical relationship. Now, this happens usually due to expectations of economic slowdown or recession. Now, investors demand higher yields for short-term bonds as they anticipate lower interest rates in the future, reflecting concerns about the near-term economic outlook, right? So that is how your typical person looks at the yield curve and understands the yield curve, why it goes inverted, and just kind of the whole theory and basis between looking at the yield curves. Now, this is a recession indicator, but oftentimes the recession does not come until we are uninverted, right? Until the yield curve is no longer inverted, and it's below zero. Now, a falling yield curve, right, typically is bullish for the market. We go back to this chart, look at here where the yield curve is declining here, right? And it ends up going inverted, right? And we see that the stock market was having a tremendous rally here. And again, it's once you see it uninverted here, once it gets back above zero, that's typically when the downturn starts or shortly afterwards. And the market's been absolutely ripping here recently, right? You see the yield curve, goes into that inverted phase. But the stock market was actually performing very, very well here. And we see the yield curve trying to climb back up towards zero. And what did we have? Well, we had a pretty significant drawback, right? And that put us into our October 2023 lows. And then the yield curve drop back down, right? And we saw the rally continue back in the market. We're seeing the yield curve spike back up again. And here we are with the S&P 500 declining a little bit. So this is how I like to monitor the yield curve is through my own chart layout in Thinkorswim. Some people like to just Google it. Some people go to Fred, and there's many different resources, but I really like being able to have one platform to do all of this research on. And if you want to know any of my other chart layouts, as I've got market breadth, market internals, I've got some specific trading chart layouts that I use for trading different instruments. Those are all available for purchase using the link in the description down below. Now, you can set most of these up for free on your own. But if you're someone that is really looking for a package of different things that you guys can look at to help gain an edge. I've got several different packages available for you guys, as well as, doing a lot of the hard work for you, right? So that way, we all know time is money. And if you guys want to save a lot of time, and rather than going and setting up these charts on your own and think your swim, saving them and having, dozens and dozens, I've literally got like 100 of these different chart layouts. You can save some time by purchasing those using the link in the description below.